How inflation reports influence currency strength. One of the most closely watched economic indicators in forex trading is inflation. Inflation reports give traders insight into a country's economic health, central bank policies, and ultimately, the strength of its currency. In today's video, we'll break down how inflation affects currencies and why it matters for your trading decisions. Let's start with the basics. Inflation measures how fast prices for goods and services are rising in an economy. Central banks, like the Federal Reserve or European Central Bank, monitor inflation closely because it affects interest rates. Higher inflation often leads to higher interest rates, while low inflation may result in rate cuts or economic stimulus. So, how does this impact currency strength? When inflation rises above the central bank's target, traders expect interest rate hikes to control it. Higher interest rates make a currency more attractive to investors seeking better returns, which usually strengthens the currency. Conversely, if inflation is lower than expected, the currency may weaken because the central bank is likely to keep rates low or even introduce stimulus. Let's look at an example. Suppose the U.S. releases a higher than expected CPI Consumer Price Index report. Traders may anticipate that the Federal Reserve will raise interest rates sooner than previously expected. As a result, USD often strengthens against other currencies. On the other hand, if CPI comes in below expectations, USD may weaken as rate hikes are delayed. Another key point is market expectations. The forex market doesn't react to the numbers alone. It reacts to the difference between expected and actual inflation. Even if inflation is high, if it's in line with expectations, the currency may not move much, but a surprise higher or lower than expected can trigger sharp movements. Inflation reports also affect trading sentiment. High inflation may signal overheating in the economy, prompting caution in equities and boosting safe haven currencies like USD or CH. Low inflation might encourage risk-on behavior, benefiting higher yielding currencies. To summarize, inflation reports are a powerful driver of currency strength. They influence central bank decisions, shape market expectations, and create volatility in forex markets. Traders who understand inflation and track these reports can make better informed trades, manage risk effectively, and even anticipate future currency trends.